Schwab Advisor Services is proud to support the RIA Edge podcast and equally proud to support independent financial advisors like you. In a challenging year, how did 68% of firms surveyed in Schwab's RIA benchmarking study meet or exceed their new client goals? By following key success factors such as leveraging new technology, adapting strategies to win new business and stay connected with their clients, while also attracting and developing the right talent. The Schwab RIA benchmarking study is just one of many ways they provide you with the insights and resources needed to succeed and grow. Get the full picture at advisorservices.schwab.com. Welcome to the RIA Edge podcast. This is Mark Bruno, the managing director of the Wealth Management Group at Informa, and I am very excited to have our final guest of 2022 on today's podcast here, Brent Brodeski, who is the co-founder and CEO of Savant Wealth Management. Brent, thank you very much for taking some time out. I appreciate it.
Yeah, thanks for having me. I've been looking forward to our conversation.
Same here. And I think a lot of our audience are looking forward to hearing what you have to say here today, because it's been an unbelievably interesting year, for better or for worse, in the RIA segment. And we've talked to a lot of people in similar roles throughout the year and gotten a lot of different perspectives on merger and acquisition activity. Savant has obviously been very active for years in that market. You've grown through M&A, but also grown organically. So looking forward to hearing sort of both sides of the story, and also looking forward to getting your views on how you think M&A will take shape in the RIA industry in 2023. So we have a lot to cover. But before we do, Brent, would you mind just giving a brief overview of who Savant is, the types of clients that you work with, and how you position yourselves in the M&A ecosystem?
Sure. So we're a comprehensive wealth management firm. Just had my 30th Savant anniversary. So we co-founded the current firm 30 years ago out of Rockford, Illinois. Thank you. And, Rockford, Illinois is about 90 miles west of Chicago. So we started there, and then we sort of put our feelers out primarily in the Midwest. And then we've continued to expand beyond that, both, out west as well as the Mid-Atlantic. We have a good presence and, looking to continue to expand organically and inorganically. I think we have 25 offices now. We're about 350 employees, about 115 advisors. We really pride ourselves. Once upon a time, we were an investment management firm, and then it became financial planning and investments, and then it was more comprehensive wealth management. And really, the business that we have and that we're building is really focused on helping build ideal futures for our clients. So, we're really purveyors of wisdom and experience, helping people, identify what matters to them and their family, and then, creating strategies, portfolios, structures to give them confidence and increase their odds of success. So it's, we work with almost 10,000 clients at this point. We manage about $14 billion of assets that range from ultra high net worth down to younger professionals that are starting to accumulate. And it's really creating a platform that provides one-stop shop finance, obviously investment management, financial planning, but we also have a very significant accounting and tax presence that is able to allow us to go deep on tax matters. We have a law firm and a estate planning firm and a trust company that allows us to draft documents and really address, a variety of matters, whether it's succession or estate planning matters. So it's really, trying to really create simplicity, ease, confidence, for our clients. And, we've primarily grown organically, but we've also done 14 partnerships over time. I hate the term M&A. M&A is like big fish swallowing little fish. And, that's connotated, with, okay, go in there and, cost save, also known as fire people. And that's not what we're doing. We really, we think of M&A as really a way for us to get great talent. It's allowing us to move into new markets without trying to greenfield. When we're in a market, M&A allows us to, create density and double down in markets to become larger, presence in key markets. And last of all, we get, new plays in our playbook, or new capabilities, new expertise, niche markets, through partnering. So we really see, inorganic as a way to, again, capture talent, capabilities, geography, because the best people aren't sitting on the street corner waving a resume saying, hire me. But, since I can't hire necessarily the best people, we can partner with people. So that's really how we think about it. And, what's kind of interesting is on the organic side, you say, what's the number one organic strategy? It's inorganic, right? Because, when we partner with firms, and they're able to plug into our platform, our brand, our capabilities, our specialists, what we find is firms that are often growing in, low, middle, single digit growth, oftentimes triple their growth as a result of becoming part of a platform. So, and I think what's different is when we do our partnerships, we're not looking to buy a book of business and have people go to the beach, and retire, right? Really, we're looking for people who can want to hitch wagons and do something bigger, better, smarter, cooler, more fun, more value creating for clients and for the members.
Yeah, and be some part of something that is bigger, growing, and has maybe a larger impact too. I think there's a lot that you just described that I think is consistent with some discussion points we've had on RIA Edge interviews throughout the course of the year, but also we've done a tremendous amount of research over the last 6 months on M&A activity, growth activity overall. And the part that you mentioned about, using M&A, even though you don't like the term, to acquire talent, we've talked about quite a bit. We've heard people mention it's easier to acquire than it is to hire talent in this environment right now. Right. So I appreciate that you put that up there. That seems to be at least at the top 2, top 3, in any or almost every acquisition that's taken place. I do want to get your summary of what it is that you're looking for specifically when you're evaluating some of these partnership opportunities and you see a firm that's a good fit. Now, I saw in the news the other day that you just acquired or announced your 5th acquisition of the year. I think correct me if I'm wrong, was a little bit over 1.1 billion in inorganic growth in 2022. So you're talking to a lot of firms, you're actively partnering with them. What does a good fit look like for Savant?
Yeah, so the opposite. I mean, I'll first of all say what we're not interested in. We're not looking for people that are just trying to create a liquidity event, get a check, and go to the beach. And so we're not looking to buy clients because whatever I'm paying is a lot, right? So what I'm really looking for is talent, and people that are excited about a shared vision. And as I think about what we're trying to accomplish, we're kind of unique. There's probably 20 to 25 platforms that are trying to grow organically, maybe have outside capital and are also doing M&A out there. And, we're one of those, but most of them are building, they got short time horizons, they got traditional private equity, and their time frame is 2 to 5 years. And so they're doing oftentimes supernatural things to pump them full of steroids, put them on a treadmill, making them run fast, and then sell them to the highest bidder in a few years, using a lot of leverage, which isn't so fun lately for a lot of those firms. And that works really well to enrich, that traditional private equity firm. But it's not necessarily good for clients, and it's not something I would want to own or be part of, right? Instead, so we're really saying we want to build one of the best operating companies, company that everybody wants to buy, but we don't want to sell because it's such a great company. We want to create a company where it's not about, short term, pump it up, but rather, let's create a sustainable, durable firm that, is long term greedy, right? Like, how do we create a compound interest machine that can and grow 10 times in the next 10 years? We just finished a McKinsey project, spent a couple $1 million, on really building this, 5-year organic and inorganic strategy. And our goal, we're about 110 million of revenue, and our goal is to be 500 million, in 5 years. Well, there's different ways to do that. You can just buy everything out there, overpay for it, don't integrate it, use a lot of leverage, and then flip the Frankenstein to another private equity firm, and cross your fingers the music doesn't stop. That's one strategy. And frankly, there's a lot of the current acquirers out there, they've done that well. To me, Savant is a employee-owned, employee-controlled, 100% of the voting stock is owned by our employees. And we're in a position where, with our capital structure, we do have family office and some long-term outside patient capital, but they can't ever make us sell the company. They can't ever make us buy them out. if we think we should turn the car right and they think we should turn the car left, we turn right, right? So it's building a firm that can compound and create big outcomes for our members, for our employees. And frankly, if we can grow 10 times in 10 years and do it in a very sustainable, durable manner, that's going to create a lot of ideal futures for our clients. I'm 55 and I figure I'm good for 20 years, God help me, maybe longer, right? But I've done the math and it's like, I think if we play our cards right, we can improve 1 million lives over the next 20 years. And we're not a nonprofit. So if we can materially move the dial on 1 million people, that will allow us to become, that'll be generous for us as well, right? So as I think about who are we looking for, we're looking for people that are excited about, not going away or selling for necessarily the highest check, right, for cash, but rather, they're looking to become part of us, right? They're looking to merge into us. They're looking to take back a material piece of equity in our firm. We've had partners that have rolled almost 100% in equity, and others that obviously they want to take chips off the table. But the idea is really to find true partners, as evidenced by the fact that they're looking to be part of something for a longer period of time, where they're excited about rolling equity in and having multiple bites of the apple. And they're excited not just about a transaction, but rather, being part of something really cool, really special.
That idea of not just return on investment, but return on impact is something we don't talk about a lot on RIA Edge. So appreciate you talking about that 1 million lives. I apologize. It's something else that sounded like you wanted to add there, Brent.
No, I'm good. Let's, I think I covered a lot of bases there.
Okay. So I also wanted to make sure that you talked about a lot of the different firms that you're currently working with, what the ideal fit is, and also just the different sort of stage that some of the firms that you're acquiring or partner might be at. The way it's been interesting to see so many deals that have taken place over the last several years, they're no longer just exit strategies. There's a lot of sell and stay. And with that, there comes a lot of growth opportunity for, the right types of firms as you described. However, 2022, we saw markets obviously take a significant dive. And everything that I'm hearing is that there still is a good amount of M&A activity, maybe slightly slowing down because of the drop in the markets. And obviously there are other factors as well. Cost of capital, right, becoming an inhibitor for a lot of smaller or mid-sized acquirers, I'd say. That said, I'd love to get a sense for where you think we are now in the RIA M&A cycle, given how much activity there's been for the last several years. And then as we head into 2023, believe it or not, I'd also love to get your views on what you think, not just the overall activity levels will look like, but what the composition of deals, mergers and acquisitions will look like next year too. So maybe we could start with 2022. Where do you think we are now in the RIA M&A cycle?
I think we're starting to see a rotation. Some of the buyers that were winning a lot, or in some cases overpaying a lot, now all of a sudden seem to be pulling their reins back. Why is that? Well, a lot of the acquirers that were doing a lot of deals, they were paying a premium, but they were also using a lot of debt. Before the financial markets started going down, before we had a bear market and rising interest rates, they were highly levered. And obviously, as profits have gone down because of the market, at the same time, interest rates have gone up and the terms on debt have gotten less good. I think that's put a number of the platforms in a world of hurt, right? And at a minimum, they've got less dry powder, so they're being a lot more cautious about what they're buying. I think at the same time, there's some other buyers out there that maybe didn't get as over levered, or maybe have had more recent outside capital investments that seem to be accelerating. I'll use us as an example. Historically, we did a deal a year. Last year we did 3. This year we did 5. I think we'll do 7 to 10. We'll never do 20 because then you're just buying everything you can buy, which is just not good for a healthy, sustainable, durable business. So I think we're going to see, if you compare 2021 versus 2022 and then 2023, I think we're going to see an evolution of who the buyers are. Some of the standard buyers will keep buying a little bit here and there, but maybe not the same volume. You're going to see some new names that are emerging. that are stepping up. I think also, there were a lot of spent oil wells that have come on the market, companies that weren't growing, that really didn't want to grow. They're just looking to have a payday. And, frankly, a lot of those were trading at multiples that I am challenged to understand. And again, I kind of understand it, because if you got a short-term time horizon as a buyer, you buy whatever you can and you don't worry about integrating it. It's a purely financial engineering. But I think maybe some of that's going to slow down. In contrast, what I'm seeing coming on the market increasingly isn't that person looking to retire and go away. We're seeing more and more, owners of firms where they've got 10, even 15 years of runway left. What they're finding is, they might be 750 million, they might be 500 million, they might even be $1 billion or 2 billion. But they're finding that it's hard to compete with the big platform companies. They see the wisdom of having deep tax bench and deep estate planning bench and trust capabilities and business succession capabilities. They see that's really a differentiator as investments and financial planning become more commoditized. These specialist capabilities become, it's easier to compete with these, right? And so I think you're seeing a lot of firms that maybe they've been growing, they make money, their clients love them, but they're saying, how do we compete against the stunts of the world? And so I think we're seeing more and more of those where they don't have to sell and they got a great business, but they're saying maybe we're better together. And so I think that's part of what we're seeing as a rotation from spent oil wells. Either they've already sold or they're not so appealing, when capital is more sparse, to, high quality firms, where, they're far more curated and far more tailored partnerships, if you will.
Sure. And I also want to make sure that we touch on, outside of M&A, just the broader growth opportunities that exist for wealth managers and RIAs in particular. You mentioned before the goal of influencing and impacting another 1 million individuals. I really think, and we were just talking earlier this week about, I asked the same question about the M&A cycle and where we were. I got an answer that, I didn't want to use a sports analogy, right? But early morning, right, was a good way of summarizing it. And I fully agree with that. I think there are so many people, especially because of the environment that we're in right now, demographics, that need professional financial advice. And while you've had a lot of growth from M&A, I think that there is a tremendous amount of growth opportunity for you and all of your partners. And when you look at some of the growth that you've had organically over the last couple of years, and then you look ahead into 2023, where are you seeing some of the most success organically, and what's driving that?
Yeah. So, there's a variety of channels. We have become increasingly successful in the digital side of things, and we've always been aggressive on marketing. Obviously, the world is moving towards digital. That's become a source. Custodial referral programs, this is a newer channel for us, but that's really accelerating. It seems that some of the custodians that, are increasingly looking to the larger platform companies, as opposed to having a bunch of small firms. So that's benefited us being in 25 locations and being obviously a big client of the custodians. I think, the other sort of trend I'm seeing, and I look back over the last 30 years, and I was doing this the other day because I had my 30th Savant anniversary, and I was like thinking about all the phases of our business, how it's evolved. And, I think back, we'll call it pre-Savant, it was wirehouses, right? And they sold stocks and they sold bonds for a commission. And then our industry evolved to products. Think of it as packaged mutual funds that had a commission, right? And then it moved to services. Think of it as AUM for 1%, doing asset allocation, rebalancing. And then it evolved again to wealth management that incorporated investments, which was more holistic, that combined, financial planning to create an experience, right? And so it's that experience, if you will. And I think the next generation, the next phase of this is transformational, like how to transform people, how to build ideal futures, how to, think beyond the investments and the tax returns and legal documents and insurance policies, Think more in the context of well-being and what matters to you. What's your legacy? What are your values? What are your priorities? And I think it's sort of like, MasterCard, like, it's not the money, it's, it's the experience that's priceless. Well, in this case, like, if we can redefine ourselves, and this is what we're spending a lot of money on doing, is really, in fact, we just invested $3 million in Australian fintech, and we're going to be investing a bunch more in that to really change, create a digitalization of the vision, values, goals, priorities, legacy conversation. Because if I think, what we're having a lot of successes is most of the people out there, the advisors out there, they're still talking investments and financial planning. And the reality is anybody can buy ETFs, anybody can do asset allocation, anybody can buy Money Guide Pro or eMoney. That's not so special, right? But having those conversations about vision, values, goals, priorities, what matters to you, that's really important. So we're finding that by changing the conversation to start there and then build the plans and portfolios and then execute those, it's game changing. And, it allows us to get more wallet share, it gets more referrals, it gets, more retention, and it's differentiating us in things like the custodial referral programs, because like that's a different, value proposition than somebody that's selling an, option overlay strategy.
Sure. And I think that is a topic. I shouldn't even really call it a topic because it's not fully formed, but it is a conversation that I've been having a little bit more frequently. We've had a couple of guests on firms that have wealth psychologists, for example, that they brought into their firms to help train, their advisors and their teams, not just to how to be better, life coaches, but obviously with so much money transferring from one generation to the next, right? There are some complicated dynamics there sometimes, right? So I agree with you. I'm really interested to see how it evolves. I am curious, just a final question, how long do you think it takes to get there?
So we made this investment and we're now co-creating this platform in the United States. We're the first enterprise client. Frankly, if you'd asked me that question a year ago, I would have said it's going to take, 5 to 10 years, and it may or may not work. I mean, we had, we looked at all the different technology out there, and there's not great portal technology. There's not great technology that addresses the non-CFO spouse. Again, the softer matters, right? And if you think about it, the people that come into our profession, they got finance and accounting degrees. They're comfortable with numbers and standard deviations. They're less comfortable about lay on my couch and tell me about your life, your childhood stuff. And I exaggerate, right? But it's that those soft conversations that are so invaluable that you learn how to do that after being 30 years in the business. That next gen, it's not natural to them. So we had, Rob Morrison, who's our chief innovation and strategy officer, and I, we had looked at all the software out there, cobble this stuff together, and concluded it wasn't out there. So we thought we were going to need to spend $10 or $15 million and take at least 5 years to build it, and maybe it would work, maybe it wouldn't work. And then we encountered a firm out there. It was called Lumient, again in Australia. And it was like, wow, this is amazing stuff. It wasn't exactly what we had envisioned. And it really wasn't ready for prime time. So we came in and became their co-creator now, and building this platform that I think by the end of this year, we're going to have a world-class client experience platform that will be able to allow us to use the technology to shift the conversation to these transformational, creating ideal futures discussions, the kind of, conversations that Rob and I, after having 25 and 30 years of experience, we learned at School of Hard Knocks. But the beauty, I think the opportunity to go from being just a financial planner or investment firm to truly transforming lives, it's about having those rich, deep conversations with clients, even when they weren't expecting that. And, but then being able to scale that and deliver that across, in our case, we're 25 offices now. I think 5 years from now, we'll be 50 offices, we'll be 30 or 40 billion, right? So how do you deliver that experience? You need technology, right? You need to digitize these soft conversations and these ideal futures conversations.
Yeah, I appreciate that, Brent. And I lied when I said that was my final question. As you were kind of talking through Lumient and some of the technology, I just had one quick final question as an add-on to that. Obviously, technology will play a huge role in accelerating, right, your evolution and the transformation that you're talking about. But you mentioned talent at the beginning of our conversation. So I am curious, from a talent perspective, what do you need that you don't have right now?
What's interesting is, as we've in the last year, we brought on, another minority patient capital investor a year ago, and the purpose of that was to really have additional dry powder to accelerate our growth. It was, to put us in a position where we had, additional people in our corner to help us think about growth. And, on the people side, what we've come to realize is we're in a unique spot. It used to be RIAs, we're local RIAs working with local clients and local offices. And the bulk of RIAs are still that, but we're now in a place being a platform company, that's tech enabled, it's across many, that's building a real brand. Like, frankly, we can attract talent wherever it is, and we don't have to be relegated to B talent or C talent in our local marketplace, because that's all there is in some cases. We can go for A talent no matter where it is. And so as I think about where we're at, we're about 350 employees or so right now, and we'll be over 400, by the end of next first quarter. The beauty of that is, as a national player, we can attract the best talent, and they can be wherever they're at. But I also think about, what do we need? As I mentioned earlier, we just finished a McKinsey project, and it's really, how do we grow 5 times in 5 years? And like I said, we're over 300 employees now. If we grow 5 times, I don't think we need 5 times the employees. Maybe we need
Sure.
3 times the employees. So that would put us at 1,000. So it's really interesting is almost 2/3 of our employees don't work for us yet. So when you ask the question, what do we not have? Well, some of those I've identified. We've got like 52 job recs outstanding right now, and that we're filling. It's hard in this tough market. But what's interesting is I know of that, the 2/3 of the people that don't work for us yet, a lot of those are going to be advisors and client service people. We're going to need more of those. We're going to have more clients. But there's a whole lot of roles that I haven't even thought of yet, right? I mean, when I look at some of the specialized expert role, positions that I have today, I couldn't have predicted 5 years ago I would have even needed them or thought about them. And I think that's the biggest, thing that I've noticed. Like, when you're small, if you're 100, 500, even a billion, you're wearing a lot of hats. You wear 40 hats, right? Yeah. And some of them look good on you, some of them don't, right? And the beauty of being larger, 350 on a path to 1,000 employees, is it gets far more specialized. The beauty of it is you can attract people that are highly specialized in more focused areas, where they can leverage their unique ability. And a lot of times these specialists are a lot more expensive, but as a growing firm, we can afford to pay them. We can get A players and afford to pay up for, the best specialists. So I'm not sure if I answered your question, but I think it's just saying, looking forward, I know we're gonna, it's A talent as opposed to B talent. It's talent wherever it is, as opposed to, local markets. And it's really being open to more and more specialization and roles that I can't even predict today, but I know will be really powerful in differentiating, us in the future.
I think that's a great place to end as well, Brent. So thank you so much for spending as much time on the podcast as you did. I think we covered some of the traditional lanes, but wanted to make sure that we spent a little bit more time on your vision, which I give you a lot of credit for. There's a ton of financial engineering going on in your space, that is for sure. So to get a sense of what your vision is, what the purpose is for the company, I think is very informative, educational, and also appreciated. So thank you for spending as much time here today as you have, Brent.
I enjoyed it. Thanks.
And congrats on the Savant anniversary, of course, right?
Yeah, that's kind of crazy. 30 years,
I love that term.
Half my life.
Again, Brent, thank you so much for joining us here today on the RIA Edge podcast. We touched on a lot of different topics and themes, and I should remind our audience that a lot of the topics that we've discussed here today, we're actually now working into the agenda for the RIA Edge main event, which will take place May 21st through May 24th in Hollywood, Florida at the Diplomat Hotel. So mark your calendars and save the date. But again, Brent, thank you for joining us. Thank you to everybody for listening in here today. And on behalf of the Wealth Management team at Informa, I'm Mark Bruno. Thanks for stopping by the podcast. Schwab Advisor Services is proud to support the RIA Edge podcast and equally proud to support independent financial advisors like you. In a challenging year, how did 68% of firms surveyed in Schwab's RIA benchmarking study meet or exceed their new client goals? By following key success factors such as leveraging new technology, adapting strategies to win new business and stay connected with their clients, while also attracting and developing the right talent. The Schwab RIA benchmarking study is just one of many ways they provide you with the insights and resources needed to succeed and grow. Get the full picture at advisorservices.schwab.com.